Arnab was there for our second meetup, I think, right?
First physical, I think.
First physical? Yeah, right. After the online meetup, you had 2 keynotes already at Crypto Invest Berlin, and I think the first one was even in the old bar where we met, which was quite rough. Quite. The food was very good. The price was affordable, but it was rough. It was
pre-inflation.
Inflation only came later. Arnab, looking forward to your presentation.
Thanks a lot. Thanks for inviting me again. Today the presentation will be shared between me and Jonas. Great presentation. I think you gave a very good kind of highlight on the market, on the entire tokenization RWA. Quick background, STOKR started in 2018. We are one of the kind of very oldest player in the market. Philipp is also here. So I would say 2 OGs are here in that space from Berlin, in that sense. STOKR started with the journey in 2018. The idea was to bring tokenization into real-world assets. That time the term was not there yet. People were still running after ICOs, going to those jurisdictions to create utility coins. And we thought, okay, we want to really fight with the regulators and get and see what comes out of it, right? And over the time, we got kind of evolved as an organization, understanding of the market and our focus, and the thesis got, sharpened and also a little bit focused. And we came with kind of a very interesting thesis in STOKR. And I think one point, Konstantin, I think in your, I'm happy to add, right? One category is which we are quite proud to bring in is Bitcoin. And STOKR is actually very unique in that because our thesis is if you have a $2 trillion asset class, which is interestingly, I was listening to a podcast yesterday from Financial Times, which was very anti-Bitcoin for a long period of time. And they were talking about the hard data of the market, where the current US market is going. And they took the Bitcoin price action as a hard data point. If the Bitcoin price is in that range of 80, 70, 90K, the market is not feeling that bad and not scared. So that's a very interesting evolution of the entire crypto, which brings to the thesis is, if it's a 2 trillion plus asset class, and if Trump does his magic and the US in that way goes in where we are thinking, we are talking about an asset class that can produce an asset over 150K per BTC in a very conservative way. So if that is the case, then you have a few hundred billions worth of derivatives and structured products in Bitcoin, which can natively stay in a tokenized format. So that's the fundamental thesis. It's like a Bitcoin as a native financial platform. And this is happening if you see a Tether, and very few people talk about that. Tether is one of the major stablecoin that is very keen. Paolo is very keen to bring stablecoin on Bitcoin layer 2. He did it with Lightning, also did with Liquid, and few other chains he will also do with different experimentation. The idea is if you want to create a stablecoin that is built on an infrastructure, you need an infrastructure without a market maker that manages your utility coin. And this is, I think, major stablecoin players are considering. So Bitcoin native financial infrastructure will be a thing, and that's happening already. And there's another thing, if you see Lightspark, there's another company that is the guys who were behind the Metas. The Facebook came with an idea one day that they want to create a stablecoin infrastructure, DM. And that got scrapped because that time the US government didn't like that angle. And the guy who started that, Marcos, he launched in Lightspark, which is actually a stablecoin infrastructure on Lightning. So you have a Tether working on Lightning, you have Lightspark working on Lightning. So that gives us a theory is, if you have the stablecoin that is on Lightning, you have the store of value on Bitcoin. So you have a stablecoin, you have a store of value, and then you can have derivatives and investment products. And we started creating that on a Bitcoin native way. And the cross-border, definitely one of the key elements of tokenization comes in cross-border. STOKR as a platform, being in the market for quite some time, we are regulated in Luxembourg. We have investors from different jurisdictions operating in a regulated environment, so we have to be very careful on the KYC, AML, all these kind of things. But we still believe the value of entire capital market is being a bigger market, right? And EU is struggling for a EU capital market union for a long time. Hopefully this will happen in some time near future. But if you want to have a proper capital market products and you want to be tradable and you have to have a bigger access, you have to have a cross-border element. And that's what actually made stablecoins like Tether, Circle, also Sing very successful. And I think this Konstantin maybe raised a very good point, right? If you see the biggest market share of the entire RWA is being dealt by stablecoin. And why this is the case, it's very interesting theory that we have also here. Stablecoin brought you treasury bill in your wallet. Now, if I have to hold $1 in my bank account, or I have to hold the dollar in as a government bond of US, I will hold as a government bond of US because I don't rely on the bankruptcy risk, or I don't get affected by the bankruptcy. And that's what actually Tether, Circle, and all these guys started to doing. And that, I think Circle somehow got a bit affected after the Silicon Valley Bank when it went down, because they still hold a good amount of chunk in their bank accounts and their users couldn't redeem. But Tether got some past experiences, so they got more smarter over the time. They kind of hedged and went more into the treasury bill. And that's kind of gave us an idea, is the money market fund, they actually got into the users where they can hold any kind of assets within $1 units or denomination. That's a very interesting. So I think they are one of the pioneers of the entire RWA in that sense. Now here comes the thesis, is the capital markets, how we can build on Bitcoin, and STOKR is doing from 2019 onwards, purely focusing on the Bitcoin layer 2. We are using infrastructure, liquid network. What is STOKR? STOKR is an asset tokenization platform. We tokenize financial assets, primarily Bitcoin derivatives, Bitcoin structured products, Bitcoin financial assets, also alternative assets. This is actually our core verticals, core focus. And we are also an investment marketplace. We provide the full end-to-end solution for tokenization. We have an asset management license under our umbrella. We have a VASP license in transition into MiCA. And like anything, like it's kind of completely regulated in that sense, what we are doing at the moment. Some of the key metrics, very few people knows about STOKR. It's not by design, but it just happened. Because the reason is for us, it's very important for us, is people knows us by our asset, by our products. We paid last year 80 million worth in Bitcoin as a payout. It's a Blockstream mining node. We launched in 2021. It's backed by Bitcoin hash rate, and Jonas will explain a little bit more in details there. I'm not talking about that. That product gave a 32% Bitcoin basis return in a 3-year period. So we outperformed Bitcoin by 32% and over 104% in dollar basis return. It outperformed Bitcoin very nicely. It raised 40 million, paid out 80 million in Bitcoin. That BMN1, after the success we launched BMN2, that raised roughly around 370 million, and total AUM under our STOKR structure till date is over 600 million at this stage. The BMN2 is a top 8 assets. Very few people can actually find the data, because on Liquid, every transaction is confidential by nature. So you do not know who is trading between whom, what value. So analytics cannot work on that. And that's by design the Liquid is structured. So this is another reason also a lot of analytics cannot work over there. But we as an issuer, we know the trading volume and the trading informations. This product is also being traded on Bitfinex, so we have also data from there. We are also a Bitcoin company. We are proud to say that. So we have over 100 BTC at the moment. Right now it's 105 plus in our treasury, and it's growing. And I think we are we're the only Luxembourg company, because our headquarters is still in Luxembourg. In Germany also, I think we will be one of the few companies to have a Bitcoin treasury. And we want to grow it more, because I think there are very few European Bitcoin treasury companies at the moment. And we need more Bitcoin in Europe, actually. I think it's a double clicking. Okay, so here I would kind of leave to Jonas to share some more data. But I think one thing, just to kind of give a high level before I kind of pass on the mic, is Bitcoin derivatives market is growing. And this is, if you see Bitcoin yield products and all these things are becoming more and more interesting. Now, the challenge where it also comes, and this is RWA and Bitcoin, where it can interact very nicely, is most of the Bitcoin yield products are not regulated securities. They're being issued as kind of a weird structure, right? Which doesn't give full investor protection. Now, if you want a complex derivative products, it makes sense to issue it as a regulated securities. And this is where I think the market is growing. So maybe Konstantin, you may have a specific category of the Bitcoin side, which I think the market, it will grow over the time.
Right, thank you, Arnab. As Arnab already mentioned, STOKR engages in the tokenization of securities, so not collectibles or art or other use cases. And as we're talking about securities, I wanted to give you a brief, I wouldn't call it history lesson, but a look in the hindsight and in the look in the future, where securities are around for 400 years. Actually, in 1600s, the first securities, the paper-based shares were issued for the trade conglomerates in the very early phases of globalization. And those securities have had like distinctive characteristics. They were paper-based. You imagine you have a ledger, which is not something like a hardware wallet we connect it nowadays with, which is just a piece of paper and people write ownership rights to it. You can imagine building a financial infrastructure, building complex capital markets is not possible with this kind of record keeping and ownership, track record keeping of ownership. And that's why at some point, when the US stock market actually was a bit overwhelmed with all those papers, there was actually a crisis at the New York Stock Exchange. I think it was like 1960s or so, where they actually had to close the stock exchange because they needed an extra day to keep track of all the paper and go into the back office to open trading again. This was the paper crisis. The securities were dematerialized with electronic bookkeeping. This had some benefits because it removed some of the inefficiencies, definitely, but it also increased the need for trust and trusted intermediaries, as we know them nowadays with the depositories and all the kind of entities that are involved in our complex capital markets right now. While this is already a step towards more efficient and broader financial markets, we see that a lot of innovation is happening, especially if you think about your brokerage, for example, where you have nice user interfaces and everything is tidied up. But still in the background, and actually how securities are settled between the trusted intermediaries, there was not much innovation happening. And that's where tokenization comes in, because you try to get rid or reduce the trust in the trusted intermediaries and bring everything into one shared ledger, where you keep track of their ownership, but also transfer the ownership rights in one mutable ledger, which makes a lot of the benefits we heard about already in the previous keynote of accessibility, transferability, efficiency, less trust involved, less fraud involved. So those are all benefits, and those benefits are definitely recognized by traditional finance, as we see with quotes from the famous BlackRock CEO, also Morgan Stanley, when they publish about tokenization. So where do we stand now with the tokenization market? We saw it in the previous presentation that real estate and T-bills, money market funds make up around 70% of the entire market. You don't see those assets on this slide. As Arnab mentioned, we're engaging with Bitcoin derivatives. We specifically and strategically didn't decide to go into those markets, and we were not that excited with those markets for one reason that real estate, we didn't see so many successful real estate projects, and we have the feeling if there is a good real estate, you don't need to tokenize it because the market is so heated up and people are actually buying the actual real estate and they don't wait for it to be tokenized after sitting on the market for a few months at least. For the T-bills, the market is quite big. We're competing with big players and we don't see the edge in doing this. That's why we found our niche in the Bitcoin derivatives and structured products, which is composed out of those three categories. So you can put the assets in those three categories. With the Bitcoin mining, that goes into the direction what Arnab said about Bitcoin yield. Currently, we see Bitcoin yield is a big topic. It's coming up. There are different approaches to it. If it be like arbitrage trading or some other yield generation through Bitcoin equities, we thought, okay, why not we structure a product that provides Bitcoin yield, so Bitcoin basis return, but with a different structure and with a different mechanism behind. And there we partnered with Blockstream, which is probably to most of you like a term, one of the largest Bitcoin infrastructure companies in the world. And we partnered with them to create BMN1. BMN1 is a node that gives investors the right to Bitcoin mining returns over a fixed term of time. So BMN1 was launched in 2021, and each node gave the investors 2 petahash of computational power in the Bitcoin mining network. So they have an actual share of the miners running in the facilities of Blockstream mining. At that point of time, it was a 3-year product, matured in 2024, and it led to the largest RWA payout with around 1,200 Bitcoin paid out in Bitcoin. So we didn't convert to USD. It was all settled and paid out via liquid Bitcoin. Based on the success and the strong investor demand, you see the circle was increasing. We launched BMN2 with Blockstream mining, currently sitting at 374 million. And yeah, just justifying and confirming again that the return that BMN1 generated, Arnab talked about it, 32% Bitcoin return, which is roughly 9.7% yield per year, quite high. If you consider you're investing with Bitcoin, which is an asset that also has a positive CAGR over the last, the entire history, more or less. We launched BMN2 as a similar characteristics, is a 4-year product for now to align with the Bitcoin mining cycles and also to change in the ASIC infrastructure, so the actual machinery that's getting more efficient. And building on this, or touching it, you see it in the graphic, is PKH, which is a mining node that has some interesting relation to BMN2, because it's a structured private credit product that is secured by BMN2. So there are sophisticated investors that see BMN2 and say, okay, this is really good collateral because we know mining is profitable, we know the track record, and why don't we borrow, or we lend actually, considering BMN2 as collateral for that loan. And you see the size is quite high and considerable for a private market asset as we're dealing with. So we're proud on those flagship products, but we're also engaging in different categories with the Bitcoin equities. Probably all of you are aware of what's going on in the US with the big companies putting Bitcoin on the balance sheet, MicroStrategy. There are other companies, also Japanese companies like MetaPlanet. They're seeing Bitcoin as a long-term capital asset. They see it as digital capital. And they put it on the balance sheet to increase shareholder value over time, and thereby they actually outperform Bitcoin. They leverage the traditional capital markets to borrow money at virtually 0% interest, buy Bitcoin with it, and they hodl. That's everything they do. And we tokenized MicroStrategy, currently sitting at around 14 million total value locked, to make it actually tradable against Bitcoin. Those stocks have a correlation to Bitcoin, and we think it only makes sense to make them tradable against Bitcoin. So people can trade with CMSTR and soon with tokenized MetaPlanet, which is going to be launched in the next few weeks. They can trade the underlying shares against Bitcoin, which is super interesting if you think about it. Traditional markets are closed on the weekends, after hours, but people still might want to speculate and trade the asset. And with tokenized CMSTR and CMTPL, they actually have the marketplace for this, and we already saw with CMSTR trading volume of roughly over $1 million since its launch, like 10 months ago. But definitely we see this is a market that will further grow. Some other alternative assets, I don't want to make it too long. We also have Basic, which is an opportunistic fund, also in collaboration with Blockstream, where they bought ASIC machinery, so the physical machinery at the time when the market was at a very low, and they say, okay, we expect the market to move up again, the ASIC market, and we want to sell those ASICs and then make the proceeds available to the investors. This is all naturally tokenized products. Also, Aquarius, AQF, is our own product, which is an alternative investment fund, naturally tokenized, which is also in the category of Bitcoin derivatives and structured products, because we're engaging with Bitcoin-backed loans. So if every one of you sits on a big chunk of Bitcoin and wants to borrow against it, feel free to reach out today. We can help you out on that. We see this as one of the big topics coming up this year, Bitcoin-backed loans, as Bitcoin is increasing in value, and you see also more companies creating Bitcoin treasuries. They are interested to borrow against the asset, keeping control, keeping the long-term growth prospects, but yeah, catering to current liquidity needs. As Arnab already mentioned, we're more or less the only player that really builds large-scale products on the Liquid network. This is not by, we don't do this on purpose, but Liquid still has a long way to go, and we see that Liquid really ticks a lot of boxes when it comes to tokenization of securities, because it has some embedded features that just make it suitable and easy and seamless for issuers. I want to highlight a few. The native asset of Liquid is Bitcoin. There is no unregistered security that is under regulatory scrutiny and might hinder issuers to say, okay, I want to use this chain. This is big, big plus. Also, it's based on the strong base of Bitcoin. Actually, the code of Liquid and the code of Bitcoin have 98% in common, so there is not much that's built on top, and you still use the UTXO model, which is just superior when it comes to security. We all know what happened with Bybit in the last few months, based on some account model problems and smart contract models. The privacy infrastructure on Liquid is privacy first, because you have confidential transactions, which is a super important requirement for financial institutions. They don't want everyone and all the competitors seeing transparently on chain, which is good for us as normal users, but not for banks, to see what kind of transactions they're engaging with and what kind of assets they're issuing on chain. That's why you don't see what kind of asset is issued at what price and so on. You only see a transaction, but not what's behind. So that's some of the key benefits we want to highlight, and we see that more and more financial institutions are recognizing Liquid for it and are using Liquid for it. And if you have any questions to learn more about Liquid or some of the benefits, we're here and we're happy to advocate also for this and discuss more. We also have our larger team here from the Berlin office, with Leonardo and Tizian with us, so feel free to reach out on a beer, on some slice of pizza, and let's discuss RWA tokenization today.
Thank you, guys. Thank you very much. Actually, I have a question. Do you have some numbers on how the investors are broken down for BMN2? Is it bigger investors? Like, what's the chunk? I don't know if you can share that, but...
yeah, we cannot share the full percentage, but it's mostly high net worth investors, professional investors, funds, hedge funds, institutional investors also. In certain categories you can bring them, yeah. But these are not retail.
Yeah. That was my question. That was your question? Okay, amazing. Are there any other questions? Questions? I mean, you can ask these guys afterwards, so you're gonna...
But BMN is actually coming on Bitfinex securities, so if you guys knows or have an account on Bitfinex, you can...
Yeah.
Product there, yeah.
Amazing. When is the third one coming?
Full disclaimer, this is not an investment advice. Please feel free to lose your money. I am not taking care of your money and anything else.
Yeah. Thank you, guys. Give it up once again. Arnab and Next up, we have Mahsa from coinIX. So, give it up for Mahsa.
Hello everyone, my name is Mahsa Doorfard. I am the Sales and Marketing Manager at coinIX, which is a blockchain venture capital based in Hamburg. And we make it possible for everyone to have exposure to digital assets. We have a liquid crypto fund and we have recently tokenized it. And today, I'm here to tell you why we think tokenized funds are better than traditional funds. So, asset tokenization and the asset management industry has entered the third revolution through tokenization and thanks to the blockchain industry. It is estimated that more than 9% of investors will allocate their whole portfolio to tokenized assets by 2027. You all probably know what is tokenization. Tokenization is converting the ownership of assets or rights to the tokens on the blockchain. So the tokens will be issued and they will be traded, they can be transferred, and it will be so much more liquid. But tokenized funds, we can say that they are exactly like the traditional funds, but they are only managed through codes and the blockchain. So one token will be issued, and it will represent one unit of ownership in that fund. You can literally tokenize any kind of fund. You can tokenize real estate fund, debt fund, commodity fund. All of them can be tokenized. And all the information will be on the blockchain. So the NAV calculations, fee executions, all the documents, everything will be on the blockchain, and you will not need any kind of intermediary in between. But what are the differences between the traditional funds and the tokenized funds? Ownership representation. So the traditional funds are usually represented by paper certifications, or they can be some digital recordings which are managed by fund administrators. But in the tokenized funds, everything will be on the blockchain. So there will be no intermediary in between. Another difference would be transparency. We all know that blockchains are transparent, public, and immutable ledgers. So there will be real-time transparency. But in traditional funds, they have limitation in transparency, and they all are managed by centralized entities. Another difference would be accessibility. So traditional funds are accessible through traditional websites and platforms and services, but tokenized funds will be available through virtual asset trading platforms. And the last one is infrastructure. So the infrastructure of traditional funds will be some centralized services, centralized systems, which is managed by brokers, by banks, by custodians, by registrars. But with tokenized funds, just again, everything will be managed by the blockchain. But are tokenized funds really better than the traditional funds? We believe they are. So tokenized funds have direct accessibility. There is no middleman. Investors have full control. In traditional funds, there will be really long lock-up periods. There will be long processes, and there are usually very high minimum initial investment amount. So there will be faster subscriptions in tokenized funds through stablecoins, and there will be lower entry barriers because through fractionalization, we can make it more affordable for more people to join and to invest. It will be automated and transparent. We will have a transparent governance. So all the information regarding the transaction history and the regulatory status, the compliance for transferring the tokens, all of these information and also the qualifications needed for the investors. For example, in our fund is only provided to professional and semi-professional investors. That's one of the qualifications needed to be one of the investors. That information, all of this information, will be encoded into the token. So everything is completely transparent. Tokenized funds will also contribute to financial inclusion. Usually, private market assets are restricted to institutional investors, and they are not that easy to have access to for everyone. But tokenized funds will be accessible to everyone. Anyone who wants to access to it can have it. There will be lower costs due to automation, and it is more appealing to the new generation. The whole process is digitized. That means the new generation, which are usually more tech-savvy than the others, will have more appetite to invest in these kind of assets. Another advantage is that tokenized funds are regulated. So the DLT pilot regime and MiFID II can be applied to tokenized funds. The DLT pilot regime implements an infrastructure for issuing, trading, and for settlement of security tokens. And it will create some kind of legal framework for tokenizing assets and funds. And MiFID II, which is the abbreviation of Markets in Financial Instruments Derivative, will analyze whether crypto assets will qualify as financial instruments. So in Europe, all tokenized units in AIF, or alternative investment funds, will be regarded a financial instrument under MiFID. So if you have a fund and you want to tokenize it, what should you do? First of all, you should choose the jurisdiction of issue. That will determine the legal and regulatory framework that you're going to be dealing with. Then you need to choose a blockchain. Do you want it to be a private one? Do you want it to be a public permissionless one? Then you should choose the characteristics of the token representing the fund. As I said, many information can be encoded in the token, and you can choose the characteristics of the token regarding the regulation, compliance, and everything. And the trading venue and the crypto registry operator. For example, we chose Niala as our crypto registry operator, and you should choose an entity that is going to take care of the digital subscriptions of your fund. And the private key holder, do you want to choose a custodian to keep the private keys for your investors, or should the investors keep the private keys themselves? And at the end, you should think of a way for interaction of the investors with the tokens. It can be through an application in a smartphone, or for example, we are discussing some partnership opportunities with banks so that our investors can see the tokenized fund directly in their bank account platform, on their websites and in the applications. Just getting back, talking about tokenizing funds is really easy, but implementing it will bring up some challenges. So it's not really that easy to do it when we really come into action. There are many challenges, there are many risks. The first challenge would be not having any investor protection regulation. There are also smart contract vulnerabilities. If anything happens with the code, if there's any problem with the code, the whole funds will be lost. And tokenized funds are very dependent on stable on-chain money, such as CBDCs and stablecoins. If they don't have access to these kind of stable on-chain money, we will have some liquidity issues. So there are also many challenges in the market. There are many tokenized funds in the market at the moment. One of the most famous ones is the BlackRock's BUIDL, which was launched in the United States on Ethereum, and it pays daily dividends to the investors. It will be directly going to the wallet of the investors. At coinIX, we saw the opportunity to combine the distributed ledger technology with the fund structure to bring the benefits of tokenization to investment fund industry. That led to the convergence of coinvest SCI1, which is the abbreviation of Smart Crypto Invest. So there will be no physical certification. Everything will be electronically registered. The crypto registry operator, which allows the direct allocation of assets to the wallet of the investor. So we did the issuance of the electronic securities as a partnership with Niala and TokenForge. Niala, as I said, was our crypto registry operator, and TokenForge took care of the compliance subscription process for our tokenized fund. So we can say that to reach the full potential of fund tokenization, we need a robust foundation. We need clarity on regulation. We need some kind of global standards for the operations. And we definitely need some kind of technical interoperability. Tokenization can definitely change the way that we invest. If you want to know more about coinvest, feel free to reach out to me, and thank you for your attention.
Well, thank you very much. Do we have any questions before we move into the last? Oh no, you keep your microphone. I'm actually going to go with mine. Before we move into the last presentation.
Thanks for your talk, Mahsa. I've got one question. How is coinIX planning to address these sorts of challenges that you were explaining before, like the ones about regulatory compliance, and also any of the challenges with the security of smart contracts? Because these could prove like a bit of a barrier for entry for people wanting to explore this sort of area.
Yeah, so the thing is that the people who are offering the fund structure need to have connections with some third parties. For example, we had this partnership with Niala and TokenForge because we wanted to make sure to be compliant, because TokenForge is the entity which is going to make sure that everything will be based on all the regulations. And we also have partnership with some companies, for example, SoftStack. They do regular smart contract audits and so on. But the thing is that the fund structures cannot do it alone. So we need partnerships. You need to be in contact with other people in the industry which are offering compliance services.
Yeah.
Okay, thank you very much. Okay, before we move to the last one, no, actually we are moving to the last one. Because I don't know if you can smell it, but here it really actually smells like pizza. Like, I literally feel I have it in my mouth already. So, yeah, thank you once again, Mahsa. And we are moving to our last speaker, who is Philipp from Swarm. So give it up for Philipp. Gonna give you the microphone.
Just try it out.
Yeah, because the slides will build. So I promise you that you're only 4 slides from the pizza. So I totally appreciate everyone coming out tonight because the weather outside is great, and the preference to be actually in a room talking about tokenization is maybe not the best preference. So thanks for coming. Maybe just briefly sort of intro. So I personally have been in the tokenization space since 2017, starting off in the United States. We were actually sort of trying. You have to open the in Google Slides. Yes, fantastic. So we started off in 2017 thinking about how to do representations on-chain of off-chain assets. Didn't call them RWAs back then. We called them security tokens, which was a stupid name. I even think that RWAs is a stupid name because in the financial markets it's called risk-weighted assets, and it really doesn't speak to the normal investor to talk about this. But in the end, since then, a lot of things has changed, and maybe just to comment on, thank you for the intro presentation, but maybe to comment on that, what has changed in the last 12 to 24 months, because that has really moved the earth in terms of what we can do in this industry, right? And I think to name a few things, number one, we actually have other players involved. Like the organizations that are now involved are the big guys, from BlackRock, Hamilton Lane, down to every single banking organization that is looking at this very seriously and saying, this is going to be the infrastructure on which we do business with our customers in some shape and form. And contributing to that was obviously regulatory clarity, and we can go into different regions to talk about what has the clarity been, and we heard a bit about Europe in the context of coinIX and others. Secondly, I think the tooling has gotten a lot better. So today we are clear what an oracle does, we are clear what a smart contract does, we are clear what the separation between issuance and secondary markets are. But then the third thing is also that the investor landscape has gotten different. So number one, we have much more value on the Bitcoin side, but number two, we also have much more sophistication by the individuals that are involved in the space, and they are getting much easier to use interfaces and technologies to engage with. So this all basically made it such that a year ago there was big treasuries moving on-chain that were like engaging into sort of high yield assets, which was the big push and big driver in the space for the past 12 months. But now we're seeing all these different institutions that are starting to really put the pedal to the metal to actually really figure out how to do this. What I'm going to talk about today is something called pushing the limits of permissionless RWAs. And we all come from a space, maybe, I don't know how much people have been involved in the space for several years, but we want this to be as frictionless as possible while still remaining within the confinements of what the regulators ask us to do. So we at Swarm have developed sort of a position on this where we are trying to serve the market with something that is appealing to the market as it stands today, while actually anchoring it in a regulatory footprint as we want it to be something that people are not worried about. Let me just see here. This is not working.
Doesn't it work?
Nope. Here we go. So who are we today? So on the Swarm side, we've been established in 2019. Fantastic. We're headquartered in Berlin, although we're not a Berlin company. So actually, I'm the only person that is in Berlin. The rest of the team is actually distributed in the UK, in Sweden, in Czech Republic. We've got a big team out in Ukraine. And still, we're trying to, for the past years, after coming from the United States, we're trying to actually see that Europe was a much, much more amendable environment for everything security token related. So when we actually left the United States in 2019, it sort of became clear that everything there was headed towards actually preventing securities to be on a digital infrastructure. And Europe had a much more holistic stance to actually allow things to happen. First in Liechtenstein, then in Switzerland, then actually sort of in Malta. But then, you know, suddenly out of nowhere, Germany came along. I actually built this amendment of the of the Investment Act and then sort of the Banking Act, and it became sort of a blueprint, not the blueprint, for sort of everything that MiCA now holds, right? But suddenly, out of nowhere, after we've had these regulations being introduced, America comes along with the Trump administration, and while there's two bills right now that are being sort of, you know, floated around, one is called Stable, the other one is called Genius, so Stable Genius. There is also the market structure regulation that is now being discussed. So we will see within the next, let's say 7-8 months, we will actually see legislation being, or stipulations being passed that will allow a very different regime in the United States to take place. And we will, again, in Europe, will have to look to the United States to actually figure out how we'll react to that in a positive manner, because a lot of the innovation is going to happen in that environment. So we do two things at Swarm. One is what you see publicly on swarm.com, which is what we talked about, basically tokenization of stocks and gold. We actually have a public market prospectus that allows us to issue one-to-one asset-backed stocks. We have been focusing on stocks that represent sort of blockchain-based infrastructure because that's where the interest of the investment community has been. But we can actually blow that up to any kind of stock that actually is one-to-one backed and distribute not just to institutional investors, but retail investors as well. We are right now moving into a much deeper integration into a banking layer, which will allow us to actually trigger buy and sell orders from within a smart contract. And that's going to obviously open up a very different interaction model with off-chain assets, where it's no longer going through a workflow connected with a custodian with, you know, semi-automatic workflows to actually do, for example, a redemption request. So if you hold a Tesla stock token, you know, when can you get money as a representation of that? But it will allow for almost like minute-based redemption processes that can either then, you know, settle in two days, or because we own the entire process, we can actually pre-finance the process, so the payout of that can happen within minutes after clicking the redemption button. Now, the redemption is a key to actually not having to replicate liquidity on-chain. Right? Because normally people ask, okay, so how much of this is happening on-chain? How deep are the pools? Because we're thinking about that like a Uniswap pool of like how much can I actually sort of do with this, right? But the trick is, if you can actually connect it very deeply with the financial markets and make it a layer of convenience on top of the financial markets, it changes the complete interaction model, how you can think about these things, right? On the gold side, I'll go into that in a second, what we made there differently. But then the second piece of the business is that we actually use the entire stack that we use on our own principal products, and we license them to other people. So we have both the primary issuance as well as the secondary liquidity modules. And our customers are anything from issuers to institutions that want to actually sort of build their own offerings using this technology, and we can do that on any kind of EVM-based chain. Right now we're connected with Chainlink CCIP, so within minutes you can move from one chain to the other, so it's no longer capped on one chain, but you know, the mobility matters a great deal. So let's talk about gold for a second, and I'm using this as an example to make clear why tokenization actually can play such an instrumental role. So anyone familiar with gold? I mean, tokenizing gold is not a new idea, right? That's clear, right? It's been going on for years, and you know, we know all the big guys in the industry, you know, Tether Gold, Pax Gold, other people. But the problem is that you have these terms of use that give them a lot of leeway how to deal with this. You actually, in fact, when you read the terms, you don't effectively know that you're holding the gold. It's promised to you, yes, and they work within parameters, yes. They sometimes actually have proof of reserves that actually appear once a quarter, maybe half year, but it's not really clear what it is that you own. And the lack of transparency there makes it really questionable, like how much I'm actually really in control over that. And then this other thing happened, which is the last bullet point there. Actually, then Mika came along with the asset reference token framework. And this made it pretty much impossible to actually have the existing players migrate into this regime. So there's obviously ways how you can do that to actually put a new one in place, but our answer to that was the following. So what we said is, number one, we want true ownership of good delivery tokens. So what we did was saying, okay, well, every gold bar, in this case an ounce bar, has a number, a certificate number, and we are going to put that into Brings, our partner, which is one of the biggest vaulting companies of the world. And you will actually know that this NFT is the ownership certificate of holding that gold token. Meaning also, you can tell us where to store it, so we can actually take it from London to Switzerland if necessary. That's going to be some cost. But the second thing is that you can have it delivered to your door if you want to. So it's a virtualized, digitized, real holding of the gold asset itself with insolvency protection. So nothing that we do can stop you from owning that. We're just a service provider in that context. The second level then is to say, okay, well, once it's digitized, why don't we do other things with this? And obviously all like smart contract based, basically saying, okay, let's build a bundling function to put these individual gold tokens into a smart contract that then as a fractionalized entity can actually be used as normal fractional gold token backed by a transparent smart contract based system, and it's usable in different DeFi applications. So in our case, we did an offering together with MetaStreet where you actually have a leverage long that you can do on gold. So that has been working really well for the past couple of months, as you can imagine. So while Bitcoin was going down by 15%, that leverage long went up by 30%. Not a bad trade. The second layer, so that's the issuance side. The second layer is actually pretty difficult from a regulatory perspective. We saw on some slides earlier sort of where does liquidity happen for these kind of issued securities. And that's been a big deal to say, okay, where can we trade these things? So we actually developed a peer-to-peer trading methodology that is a fully collateralized trading entity. So when you say here, I'm wanting to trade this USDC for my MicroStrategy token, I can set the price, and it can be dynamically or fixed to a data oracle. And it's allowing me to do that without a principal in the middle of that equation. It's happening all atomically swapped within a smart contract. So we cannot control that at all as a marketplace. It's basically a peer-to-peer offering. Now I can actually enhance that by putting different other things in place. I can say, okay, well, I want this to be a partial offer or it's a full offer. So I can do a block trade, for example, right? I can make it a private offer, so I can specify your email, your address to be the only recipient for this offer. I can put a time lock on there, so if you need a week to decide, and we agree on this for a week, well, then it's locked up for a week. I can actually put some contact information there, but also I can put a qualifier there saying, okay, you know what? I need a universe of qualified people on the other end that can be the recipients of that, right? And it's not just that there's a selection list of organizations that can qualify, which we could do, but it's also that you can actually, as a user of this platform, you can specify your own qualifiers. You can actually go out and say, okay, I have my own onboarding process, I'm sharing that with other institutions, and therefore I'm going to specify that as the only recipients of this offer. So what's next? Very clearly lending and borrowing, right? That is a huge opportunity space for the blockchain space to thrive over traditional markets. That's not just the 24/7 marketability, but it's also just the pooling ability. And normally this is only accessible to certain qualifications, certain institutional players in the market. Now what it needs is this fast redeemability. So before not having the fast redeemability, any RWA is sort of toast if there's not liquidity. So you have to have that in place in order to make that all work. The second is we've already executed on this called proof of reserves, where it's not just, I think Chainlink does this, where they have like auditors that are a certain qualification to read smart contracts, right? Which is not real, it's a snapshot model. You're basically doing this once a quarter. But in our case, what we did was we put together a proofing technology that basically takes API calls and emails coming from the custodians and puts that transparently on chain. And then it combines it with something called ChainWiki, where you can actually have an attestation of your data claim on chain, proving that this is actually something that cannot be reversed. Managed wallets is a convenience thing. We are seeing a lot of those things in the market, but it's actually going to move the UI away from specialists to feeling more like Web 2. And one of the other big benefits of actually blockchain-based systems in this case is something called yield distribution.